I mean, we're seeing it from all of the above is the answer. And interestingly, it's not just southern Spain. Portugal, Spain, Greece, actually to a lesser degree Italy still, but sort of Portugal, Spain, Greece, and even Cyprus, we see very significant international demand for tourism-oriented real estate, whether that's hotels or second home residential. Mm-hmm. And clearly the driver of that is a perception that there is a disconnect between demand and the local economy, i.e. as long as people in Northern Europe are making lots of money, they're going to come and spend money on hotels in those locations or on buying second home residential. And so what we're seeing is investors coming in to exploit that perceived opportunity, and they are coming from everywhere. We've seen Chinese money coming in, we've seen Middle Eastern money coming in, we've seen Northern European money coming in, we see op fund money coming from UK and foreign investors fueling that market. And on top of that, you have money coming from coming from countries which benefit from the passport and visa schemes coming in. So, for instance, there's quite a lot of Chinese money chasing development opportunities in markets where they know that they're going to sell those developments out to Chinese passport buyers. So I think the simple answer is it's coming from just about everywhere.
And so this is the golden passport kind of thing in Portugal and
Cyprus, and in particular. Yeah.
Okay. And is that changing the market in Portugal as well? Does anybody have a view on that?
It's relevant in Portugal. I mean, you know, in none of these markets does it represent an enormous percentage of the market, but it is a relevant underpinning of activity and schemes in the country where those projects where those passport schemes are sensible. A country where we see actually the greatest evidence of it is Malta, but that's of course a tiny market, so it doesn't take too much to move the market.
The issue with investment into hotels is the quality of the assets in the first place. On the added value side, in city locations where they are looking at potential 4-star, 5-star value add, the value add lies in having a brand, an international brand. Unlike in London and Paris and Tier 1 cities, the international operators don't go for leases. They take management contracts, which place all the risk back on the actual owner. The private equity funds don't like tying into a 20, 25-year management contract. It's just not what they normally do. So there's a fundamental problem there. In the resort sector, you've got the issue about IRRs. If you're developing a greenfield hotel, you simply cannot hit the 18% plus equity IRR which investors are looking for. On the residential side, similar problems, absorption rates. On the residential side in city locations, no problem whatsoever. Barcelona, Madrid are hitting absorption rates which was seen back in 2007, where major developers, like the investment made by Lone Star into Naynor Homes, they bought thousands of sites. They're launching sites in Barcelona, in Madrid, where they're selling 50 to 150 units a year without a problem. Across Spain, Portugal, Cyprus, Malta, if you remove the passport program, the golden visa program, you don't see absorption rates of more than 30 units, 40 units maximum per annum. And there is no way that you can, with that, get the kind of IRRs which the funds are looking for. And that's one of the reasons why investment in the second home sector so far has been a lot more limited. Golden visa, yes, it's very popular, but there's a huge question mark over it, over how long it's actually going to last before the EU potentially clamps down on what is effectively means-tested immigration, at the same time as we're having a massive debate about illegal immigration or refugee immigration coming into the EU. So those are the sort of answer some of the questions that were raised on the residential side and the second home and hotel side.